Hello.
Are you staying dry?
No, I'm not.
I'm sick of this. I'm so sick of it. I feel like I live in the Northwest.
I don't pay California taxes to have Oregon weather. How many times have I told that joke in the last month?
That's a really good point. Yeah.
No, it's terrible. I mean, we got like the sunshine over the weekend really revivified me. And I got out in the garden, like moving rocks and mulch around. It was so nice.
Yeah. And then it just came right back
to it. I know we need it. We're supposed to be grateful.
But I'm just so tired of moving all my outdoor furniture around because the pillows and all the stuff blew everywhere across the yard. Oh, it's terrible. Terrible.
Such first world problems.
Yeah, no kidding, right? We shouldn't be really
my garden pillows. Yeah. But yes, like it's so annoying.
Yeah, we're
all depressed collectively, I think.
Yeah, we need some good weather. We need some spring weather. I mean, it's already almost, April. We should be like already going outside and hanging out in lounge chairs and stuff.
Exactly.
Come on, it's California. Anyway. So welcome to A Place of Possibility. We are happy to have you here. I am Richard Del Monte.
I'm Angela Wright.
Thank you for being here with us. What are we talking about today?
Today we are talking about the prediction business, and specifically market predictions. So, usually when someone's an expert in their field, we can go to them, with our issue, and we can generally expect to rely on their advice because they're an expert, right?
So like you go to the doctor and you say, I've got this illness, and you said you'll be fine in 5 or 6 days if you take these meds.
Yeah.
Right? Yeah.
Yes, okay. Exactly.
You can actually rely on their answers. Right.
But in the investment business, people naturally assume that the expert, the person that they're watching on TV or who wrote the article in the Wall Street Journal or even their own financial advisor, can accurately tell them how the markets are going to perform in the future. You see me laughing. The problem is they can't. There's absolutely... Yeah, really. There's absolutely, I'm about to spend the next 30 minutes proving it to you, actually.
Okay.
There is no reliable evidence that anyone or any group of people can effectively predict the short-term direction of the stock market. But that doesn't prevent the prediction business from having a massive and profitable life of its own. The problem is no one really goes back to check on them, like whether or not these predictions were accurate.
Until now. But this matters so much because, people are naturally inclined. We're wired to want to believe that it is possible to predict the future of the market, the short term, because everybody hates uncertainty.
Yeah.
So they end up relying on the predictions of these market, prognosticators, and the results are pretty much uncorrelated with what ends up happening in the markets. In other words, their predictions are completely useless. And I know that's hard to believe. We're going to show you some examples, though.
It is. And I think if you're one of the people that, really enjoys looking at these and wants to know, don't get down on yourself. Like you have a biological mechanism inside of you that makes you want to know and that wants to get rid of all uncertainty. So it's not your fault. You're hardwired to think this way.
Right. And so the financial media serves that, just like the tobacco industry serves your need for nicotine.
Yeah.
So there you go.
Yeah.
Here's a great example. We're going to start off, and this is kind of a funny one because most of you know who Jim Kramer is, right? He's the host of Mad Money. He's on CNBC, bald-headed guy, throws things around, and he's just he's kind of a showman. He comes across to many people as an expert, despite all of his showmanship that he does. So people kind of take him as if he's an oracle, like, well, Jim Kramer says, blah, 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 right?
How many times have you had a client come to you?
Kramer said this, or the market's coming, we're going down into a recession or whatever. Well, his stock picks and recommendations have been relatively poor, let's just to say the least, such that you would have actually done better just buying the S&P 500 instead of following his advice. And so now his record is so abysmal, predicting things, that there has actually become an exchange traded fund has developed, has been created that does the opposite of what Jim says to do.
I love this so much.
And the ticker of it is SJim. In other words, short Jim. Go the opposite of what he's doing. And year to date, I haven't checked it for today, but recently, year to date, that fund, that ETF was up 33%. by doing the opposite of what Jim Kramer tells people to do on his show. Now, if that doesn't make the point we're trying to prove to you here, I don't know what will.
I just gotta laugh at this because, if any other advisors are listening to this, like, the bane of our existence.
Oh, Jim Kramer's
Jim
one
Kramer,
of them, for sure.
right? Like, how many years? 15 years at least this guy's been on air, maybe 20.
Yeah.
And it's like, how he still has a show, I don't know, because his advice is so bad.
People watch him, though, and they don't check. They don't go back and look.
Yeah, I'm not saying invest in this fund, but its annual returns have been pretty good.
Yeah, the record is available if you want to look into it.
Yeah, and so sometimes these recommendations aren't just lousy, but they're downright harmful to your overall financial health and mental health, frankly, because they play into your fears and built-in biases that act as confirmation of what you already think or fear is going to happen, right? And we have this innate need to, get rid of anything that's going to harm us in the future.
Right.
And so one of the examples is they call them Permabears, as in like bear market or down market. They never stop predicting a worldwide stock market meltdown.
Armageddon, it's coming.
Oh my gosh. Except we believe these people when they say Armageddon because they're wearing a business suit and on TV.
Yeah, exactly.
But like, we're technically on a TV right now. So, don't believe everything you hear.
Case in point.
I mean, so, they sell these newsletters and newspapers and magazines, and people gobble them up because we live in fear of the next stock market hiccup. And we believe that these people or these entities can protect us from these losses. Hope springs eternal, that next week or next month, they're going to turn out to be right. And at some point they will. Stopped clock is right twice a day after all. And the markets are cyclical by nature. So if every day I tell you it's going to go down, at some point I'm going to be right.
Right. So the financial media is totally complicit in this whole charade as well. Have you ever noticed how when the markets go down, they're always showing some guy, like if you look in CNBC or the newspapers, they're always showing some guy going like this, or holding his head or looking just horrified, like it looks like he just stepped on a black widow spider, also, right. And when the markets are having one of their perfectly normal bad days, they come. The markets are predicting every time the market goes down another 100 points. A new headline is coming up, saying, and they use words like the markets are plunging,
so
or they're calling it a sell-off, or my very favorite, they call it panic selling. Oh my, panic selling, And they make sure that that this was the worst drop in 3 days or 5.5 months or 6 months or since the beginning of the year. And they also will be really fast telling you, all the gains you've made this year have been wiped out now.
And there was a headline like on January 5th or something that said that.
Yeah. I mean, you're like, what could be more horrible, And it's just, and they're trying to get you to be frightened. And let me see, what else was I going to say here? Instead of providing reassurance like they should do, they trot out one of those Permabears to tell you more reasons about, based on their own double secret research that they have that nobody else knows about, why a crash is coming.
And I just want to take a moment to get on my soapbox once again and talk about the financial media.
Yeah.
Media is a business. These people do not go to work every day out of the kindness of their hearts to educate you, dear listener, on the financial markets so that you can earn more money. They don't give...
They don't care.
Let me know. I was going to cuss. They do not care about you. They care about their shareholders. They care about selling ad space to you. And if it doesn't bleed, it doesn't lead. Right? They get up there and say, oh, everything's hunky-dory in the markets today.
You're not going to watch. You're going to go play golf and have a fun life.
Bye. So please, do not forget what the news and what the media, what their mission is. Like, this is not some conspiracy. They're just a business.
Yeah.
And grains of salt with everything.
They are not there to educate you and make you a wise investor.
No.
Yeah. Not at all. So just erase that from your thinking.
Yeah. Okay,
all
so
right, let's give some, you're going to love these, folks.
This is like, okay, just for funsies.
Yeah.
We're going to review some past market predictions and we're going to prove to you why we're right and everyone else is wrong. First, we got a little news flash though. And I don't know if everybody has heard yet, but I want to make sure that you all know that the IRS and now California in most counties have extended the tax filing deadline due to weather disasters, essentially. And so
have there been some? I haven't noticed.
Just a few this year.
Yeah.
And so if you are in an impacted county of California, your new federal and state tax deadline for your 2022 return is October 16th. 2023. That means you don't have to pay a tax if you owe it. You don't have to file an extension to get this. And you have all the way until then to make your retirement contributions, like your IRA contributions for 2022. So we have a lot of time to get that done.
Yeah. And the thing to keep in mind is some people go, oh, I'll just pay it anyway. And in April, that's a foolish thing to do, because remember, you can delay paying your taxes for 5 more months. That's almost a half a year. And when decent money market returns are yielding 4.5% to 5% right now, that if you can delay it for half a year, that's 2.5% interest that you are foregoing on your tax bill. So it's the same as saying your tax bill might only be 97.5% what it was.
Yeah. So
why would you not wait and do that, right? Unless, of course, your money's sitting in banks, that brick and mortar banks that pays 0%, then it doesn't matter, but if that's the case, refer back to one of our prior podcasts on banks and interest rates, because you're getting hosed.
Yep.
All
right, let's get back to our review of market predictions for 2022. So they're usually made at the end of the year by large banks and financial institutions, brokerage firms, and they make these really confident forecasts. They've got all of this data to show you. And
we know.
Yeah, it makes it seem like they can, predict the future.
Right.
So JP Morgan on December 15th of 2021, they produced their 2022 market outlook. And
thank you, JP Morgan.
I'm going to read what they said. So they anticipate a bright future for investors in 2022 with expectations of further equity market upside and above potential growth.
Oh, wow. Sounds great. Where do I sign up?
They go on to say earnings growth would be better than expected, according to the brokerage firm's economists. And overall, we will experience a strong cyclical recovery with a backdrop, this is my favorite part, of still easy monetary policy.
If that's easy monetary policy, I don't.
It's notable.
Bring on the hard stuff.
If you don't know what that means, this is notable, of course, because the Fed went ahead and started raising interest rates basically immediately at the beginning of the year.
Right.
And they tightened monetary policy all year long, and they're still doing it.
Right.
So JP Morgan predicts that GDP growth for 2022 would be 3.7% in the US, and there would be a lot of market upside for stocks. They also predicted that the S&P 500 would reach 5,050 points by the end of the year, which would have been a 20% gain on the S&P. And what we now know, of course, is that the S&P actually lost 20% in 2022.
What's 40% between friends? It's not that big of a deal. Come on. But could you be more wrong?
No, Chandler.
That's the point. You could not possibly be more wrong. So lest you think that JP Morgan was an outlier and just has terrible economists, let's turn to Merrill Lynch's predictions for 2022, made at the end of 2021. Their investment outlook, published at the end of 2021, was called, get this, The Great New Dawn. Woo, that sounds big. And among other things, Merrill's crack economic team predicted above trend economic growth and a budding equity culture, which will drive the secular bull market for years to come. And U.S. stocks, Merrill customers were told confidently, will provide a combination of growth, quality, and yield characteristics. Profit margins should also remain elevated for U.S. equities. And the report concludes that the macroeconomic backdrop should remain supportive of equities. Well,
the funny thing is, it was all macroeconomic issues that took us down.
That killed us, right? That brought everything down. The worst bond market in history, and they're just oblivious. They had no idea what was happening. Right.
Okay, so at the same time as all this, Citigroup comes out at the end of the year.
And
they published this Outlook 2022 white paper entitled The Expansion Will Endure, Seeking Sustained Returns. And this study report predicted continued economic growth and moderating inflation. And then lately, in a slight elaboration, we're told global GDP growth will be solid and inflation is likely to retreat to tolerable levels in 2022.
Oh.
And now, of course, we know that
guys.
Inflation spiked, interest rates spiked, and it's almost silly to read these predictions that, interest rates will be low or negative. And the capper is this doozy. We believe the world economy and equity markets have not peaked and have room to grow. I mean, okay, technically that's true in the long run, but it was very much not true for the year of 2022.
Yeah. And here's another one. Blackrock Investment Institute, not to be outdone, said, we see another year of positive equity returns coupled with a down year for bonds. Well, the S&P finished down 20% for the year. Good thing we didn't go all in. While they were right about bonds, their reasoning was all wrong.
Yeah.
And I mean, it goes on and on. We picked some of the doozies, but they're all, pretty much everybody got it wrong. I got to appreciate everybody's optimism. As an eternal optimist, I do appreciate that. Yeah, me too. But investors who listened to this advice were burned last year. And, needless to say, none of these firms foresaw an actual war, a nasty bear market decline in the US and abroad, and a dramatic rise in rates or the economic slowdown that we've all been living through. Right. So this is why when you read an economic report issued by one of the big banks and brokerage houses, or you see an economist or a so-called financial guru prognosticating in the Wall Street Journal or on CNBC, rather than listen to them and what they're trying to say to you, you should imagine a picture of somebody wearing a wizard's hat and a robe decorated with stars and half moons staring into a crystal ball, because that's what you're seeing on TV and listening to. As tempting as it is to imagine otherwise, nobody, and I mean nobody, right, can accurately predict the short-term future performance of the financial markets. This is why we in our firm do our best never to try. It's a fool's errand. And really, it's not germane to how your money's going to do or your financial future, whether you're going to be able to retire the year you want to or stay retired if you are retired already. And so to prove the point, I recently had an opportunity to do some research, and you could go back and look at funds that you know about going back many, many years, decades, even into like centuries, like me, right? The one you invested in when you were first born. Yeah, in 1934. So that fund actually, if you, it's called Investment Company of America, if you want to look it up. But going back to the date I was born, in 1934, there were financial, they were on stone, they were carved into stone, but they were there. But I looked, and if you invested, $100 in, the day I was born, and what would it be worth today? It would have gone up 102,000%. That's amazing. 1,000% in my lifetime. Now think about it, because there's been 3 50% market crashes during that period of time, a one-day crash of 22%, several 30% declines, like the one we just had during the pandemic, and other ones, and then innumerable 20% declines. And you would think with all those declines, we'd be broke, right? No, we're up 102,000%. So I rest my case. Why should we care about the short-term direction of the markets? It doesn't matter. Yeah. It's a diversion. Yeah. I hear a lot of people say too, like, well, it's different now. This isn't the 1950s anymore. It's not the 70s anymore. It's different this time. That's probably like, if I see that in an article, I immediately stop reading it because it's not, because you had all of those declines during those periods, and the reasons will be different, duh. Right. But the fact that the markets recover is not changing, right? And so long as capitalism lives, this economic system will continue to produce the same results. There's no reason to believe otherwise. And just try to kill capitalism. Ask the Russians during when you couldn't get anything in the stores were empty during the Soviet Union. The black market was where people got things. Guess what? The black market is capitalism. Yeah. It's pure capitalism. Yeah. So you're not killing it. Yeah. It's a weed that's never going to go away. Yeah. And frankly, because of this, it's not hard to predict long-term market returns. Right.
And, 1,000% is kind of nebulous. That breaks down to like between 9 and 12% annually on your returns. If you just threw your money in like the S&P 500, let's say, and never thought about it again.
Right.
And there's no reason to believe that's going to change in the future. And I also want to say, it is really easy to sit here in hindsight and make fun of these economists. Like they're, these are legitimately extremely intelligent people
no doubt,
who are working really hard to make these predictions. But in the end, they're working for organizations that are selling ad space. And we need to remember that.
Yeah. Okay, so this is going to be a hard one for some of you to swallow, maybe many of you, but you really need to be able to trust and rely upon the current market and security prices that exist, because they actually provide the closest approximation of fair value of those securities and the markets that is possible to get. So I'm going to make my point here. So consider how many people around the world are invested in the stock markets around the world today, right? There's probably 1-2 billion of them out of 7 billion. I think it's a fair guess. Either through their 401k plans, private plans, businesses, whatever, right? And so we should treat all that collective brain power as the world's biggest supercomputer. Why do I say that? Because it includes all the people who are bearish about the markets and are putting their money in coffee cans in their backyard or underneath their mattress. Their absence from the market actually has caused the market to go down a little bit lower than where it would have been if they were in, right? That makes sense. And also, it also includes the people who are very optimistic and have their money in the market. And also the people everywhere in between. They're all in there. All of those billions of people's hopes and dreams and fears are all priced into the market right now at this moment. And the market price also incorporates all the publicly known facts that exist right now. So about the market. So it can include inflation, recession, oil prices, Ukraine, Russia, the Congress, the president, who might be president next time. All that stuff is already priced into the market. It's all there already. So Joe Schmo comes along and he says, I'm getting out of the market because we're going to go into a recession. That's what I think. Now, don't you think everybody else already knows we might be going into a recession? We all know it's possible. It's not a secret. Joe doesn't have any information that the rest of us don't already have. So what it comes down to is Joe is just acting on a hunch. He thinks he's smarter than the supercomputer. But is he?
I would advise Joe to go see a psychiatrist about his need to be in this secret society that knows more than everybody else.
Good point.
Yikes.
Good point. Yeah. So let's show them how the supercomputer actually works.
Yeah.
It's a good example.
Okay. It is hard to buy this because there are people, like even clients, really smart people will come to us and like, but I heard, or I think, or, okay. So there's this experiment. You could duplicate it if you wanted to. It demonstrates collective wisdom. If you're watching us, we're going to put up a slide. If you're not watching, you can grab this in the show notes. But it's a jar of jelly beans. Researchers put these jelly beans into a bar.
Okay.
Can we go get a drink? And they asked a large group of people to guess how many were in the jar. So the individual estimates of this group of people ranged from 409 on the low end to 5,365. Like the same size jar. Someone thought there were 400 and someone thought there were 5,000. That's really interesting, right?
Yep.
But the average of the estimates was 1,653. Now, the actual number of beans in the jar was 1,670.
So they were only off by 17 beans.
17 beans collectively on average.
Supercomputer.
Yeah. So our collective wisdom is unbeatable. Now, that doesn't mean that we don't get like wacky in times of panic, right? Somebody, invades a country and we all freak out. And that happens. And for the Warren Buffett types or the opportunistic investors, these create opportunities.
The smart guys.
Yeah, that's what we like to think. These create opportunities for investors who are willing to go against the grain and do the opposite, basically, of what everyone else is doing.
Because eventually people come back to their senses and the supercomputer works again.
Yeah.
But 99% of the time, the supercomputer is number one. Mm-hmm. Right. So the moral of the story is, why bother even trying to predict at all? Not to mention get worked up about the short-term direction of the markets, and who cares if it goes down temporarily? It doesn't matter. We know that the markets are going to average 9 to 12% over the long run. That's all you need to know.
Yeah. And I think when you combine both like the mental aspect, the mental pressure of trying to completely optimize this, like to the 100th of a percent with your overall lifetime return, like the effort is not worth the value that you get, and the potential challenges to your own well-being are not worth it at all.
Right.
And so the real key, we've like told you what not to do. Can you give us something useful here? The real key to successful investing is to build a portfolio that is already prepared for the unknown, for those times when a megalomaniac invades a country, or a bank fails, or a company gets accused of fraud and goes down. Like, we know these things are going to happen, and you can actually build a portfolio to withstand them, because we never know when. You just have to always be ready for this sort of thing.
Exactly.
So when it does happen, it doesn't throw us off our game. And so understand your own financial objectives, and either figure out how to build a portfolio that meets those needs while with being able to withstand these potential unknowns that are going to rock the markets in your portfolio, or hire somebody who can. Right.
So everybody else can be surprised and shocked when these things happen. You can be thinking, I knew that something was going to happen, and we're ready.
Yes, exactly.
Perfect.
It's how we can sit here all sanguine, when the markets are blowing up, because we were already prepared for this.
Yeah. People say to us all the time, are you frazzled because the markets are bad? Like, no, this is just part of the deal.
Yeah.
We know these things happen. We're just rolling with it.
Yeah. And taking advantage of opportunities where we can.
Right.
Yeah. Did any questions come through?
No questions. Everybody's like
just laughing and moving on. Fair enough. Well, that's all we have for you today. Please like and subscribe wherever you're listening. If this did bring up a question, a comment, a cuss word, an idea, you can send it to us at info@aplaceofpossibility.com. If you want to book an appointment to have us take a look at what's going on with you, you can click on our calendar links and get on the calendar with us. You can also get a free copy of The Investment Answer. It's a wonderful little ebook on the science behind how to build a portfolio that can withstand this stuff. So if you're a DIYer, you should probably grab that. Yep. That's all for today.
Okay. So we really appreciate you being here. We hope this was of value to you. Until next time, remember, you're invested and so are we. Take care. Thank you.